Have you ever looked at your brokerage account and realized it looks a bit like a kitchen junk drawer? You've got a couple of shares of a random AI stock you bought on a whim, 3 different total market ETFs that basically do the same thing, a crypto coin your cousin told you about, and maybe some bonds that haven't moved in 3 years. I've been there. When I first started investing, I thought more was better. I thought if I owned 20 different ETFs, I was diversified. But in reality, I was just overcomplicating my life and, frankly, killing my returns. Welcome back to the channel. Today, we are ending the chaos. We are talking about a strategy that I believe is the sweet spot for the modern investor. We're calling it the Nerd Trinity, a 3-fund portfolio consisting of VOO, QQQ, and SCHD. Now, why these 3? Because they solve the 3 biggest problems investors face: the need for stability, the hunger for growth, and the desire for cash flow. In this video, we aren't just going to look at some tickers. We are going to go back in time to see where the 3-fund portfolio started, why the traditional 3-fund portfolio way might be slowing you down, and then we're going to run a massive performance simulation. By the end of this video, you'll have a clear, actionable roadmap to build a $1 million portfolio without needing a PhD in finance. Let's get started. To understand why VOO, QQQ, and SCHD are so powerful together, we have to look at the history of the 3-fund portfolio. If you've spent any time on investing forums, you've heard of the Bogleheads. They follow the philosophy of Jack Bogle, the founder of Vanguard. The classic Boglehead 3-fund portfolio is the grandfather of all passive strategies. It usually consists of VTI, which is the total US stock market, VXUS, the total international market, and BND, the total bond market. Back in the 80s and 90s, this was a masterpiece. Because you owned everything. Every small cap company, every international emerging market, and every corporate bond. It was low cost and it worked. But here's the problem we face today. For the last 15 years, international stocks have been a massive anchor on returns. If you held 30% in VXUS, you missed out on the greatest bull market in US history. And bonds? With inflation being what it's been in the 2020s, holding 20% in bonds hasn't been safe. It's been a guaranteed way to lose purchasing power. People realized the old way was a bit too defensive for wealth builders. So, different versions started popping up. You had the Growth Junkie 3-fund with UG, SMH, and QQQ, which is great in bull markets but terrifying in crashes. You had the Income Seeker 3-fund with JEPI, DEVO, and SCHD, which is great for cash flow, but you miss the big growth. The VOO, QQQ, and SCHD blend is what I consider the modern evolution. It takes the efficiency of the US market with VOO, the aggressive innovation of tech with QQQ, and the disciplined quality of dividend growth with SCHD. It's the perfect balance for someone who wants to grow their wealth aggressively but actually be able to sleep at night when the headlines get scary. Let's break down the first pillar, VOO, the Vanguard S&P 500 ETF. If your portfolio is a house, VOO is the concrete foundation. It tracks the 500 largest, most successful companies in the United States. When you buy VOO, you are betting on American exceptionalism. You are owning the companies that define our world. Why it's my favorite is because VOO is market cap weighted. This is a fancy way of saying that the bigger and more successful a company is, the more of it you own. It's a self-cleaning mechanism. If a company starts to fail, think of the giants of the 90s that aren't around anymore. They slowly lose their spot in the index and eventually get kicked out. Meanwhile, when a new powerhouse like Tesla or Nvidia comes along, they are automatically added and their weight increases as they grow. When we look at the metrics, the expense ratio is 0.03%. That is $3 a year for every $10,000 invested. It's basically free. For diversification, you're spread across tech, healthcare, financials, and consumer goods. Its role is that it keeps you tied to the market. If the S&P 500 is up 10%, you're up 10%. It prevents FOMO, the fear of missing out, because you are the market. However, VOO alone can be a bit average. If you want to outperform the person next to you, you need a little more juice. That's where the second pillar comes in. Pillar number 2 is QQQ, the Invesco Nasdaq 100 ETF. If VOO is the foundation of the house, QQQ is the high-tech, solar-powered, turbocharged engine in the garage. QQQ tracks the 100 largest non-financial companies on the Nasdaq. That non-financial part is key. It means you aren't holding slow-moving big banks. Instead, you are heavily concentrated in technology, consumer services, and healthcare innovation. So, why do we add QQQ if we already own some of these companies in VOO? Because we want to overweight the winners. We live in a world driven by AI, software, and digital transformation. The companies in the Nasdaq 100 are the ones writing the code for the future. Looking at the metrics, over the last 10 years, QQQ has historically outperformed the S&P 500 by a significant margin. But here is the volatility warning. QQQ is like a sports car. It goes faster, but the turns are sharper. When the market dips, QQQ usually dips harder. For instance, in 2022, while the S&P 500 was down around 18%, QQQ dropped closer to 33%. If you only held QQQ, you might have panicked and sold at the bottom. That's why we need a counterbalance. We need something that keeps us sane when the tech sector gets hit. This brings us to the third pillar, SCHD, the Schwab US Dividend Equity ETF. A lot of people hear dividend and they think of their grandpa's utility stocks. But for us, SCHD is something much more powerful. It's a quality filter. SCHD doesn't just look for companies that pay a dividend. It follows a very strict formula. It looks for companies with high cash flow to debt, meaning they aren't broke, a high return on equity, meaning they are efficient, and a 10-year history of growing their dividend. The logic here is that when you buy SCHD, you're buying companies like Home Depot, Pepsi, and Texas Instruments. These are companies that actually make physical products and generate massive amounts of cold, hard cash. Why it's the shield is simple. In 2022, when QQQ was crashing 33%, SCHD only dropped about 3%. It was the anchor that kept the portfolio from drifting away. It provides a value tilt that balances out the growth tilt of QQQ. Plus, it pays you a dividend, usually around 3% or more, which feels amazing during a flat market. It's the passive income part of the dream. Alright, let's get to the part you've been waiting for. Does this actually work? Let's run a simulation. Imagine it's January 2012. You have $10,000. You have two choices. Choice A is the classic S&P 500, which is 100% VOO. Choice B is the nerd Trinity, which is 50% VOO, 25% QQQ, and 25% SCHD. For choice A, your $10,000 grew at about 12.2% per year. By early 2026, you have $51,600. That's a 5x return. Incredible, right? Now look at choice B. Because you had that 25% turbo boost from QQQ, but you also had the quality shield from SCHD, your portfolio grew at 14.1% per year. Your $10,000 turned into $68,400. Think about that. That is an extra $17,000 just for changing 2 tickers in your account. That's a car. That's a year of college. That's the power of optimizing your path. When we look at the stress test of 2022, VOO was down 18.1%. The nerd Trinity? Down only 14.5%. Not only did you make more money over the long run, but you also suffered less during the bad years. That is the holy grail of investing. Now, I know what the critics say. Look, some of the holdings are in the same stocks. Yes, there is overlap. VOO and QQQ both own a lot of Microsoft and Apple. But as an investor, you need to understand the difference between diversification and concentration. In VOO, you own Microsoft at a market weight. In QQQ, you're saying, I want to bet extra on the future of software. In SE, you're saying, I want to own the profitable, boring side of the world. We are tilting our portfolio toward the parts of the economy that actually work. I'd rather double dip on Microsoft and Apple than own a bunch of failing retail stores or dying international banks just for the sake of diversification. So, how should you set this up? For me, I love the 34/33/33 split point, 34% VOO, 33% QQQ, and 33% SCHD. But the best part of this 3-fund strategy is that it's a sliding scale. The aggressive path for those aged 20 to 30 might be 40% VOO, 40% QQQ, and 20% SCHD. You have decades to recover from drops, so you want to maximize that growth. The balanced path for those aged 30 to 50 might stay at that 50/25/25 ratio. It's the perfect all-weather blend. Then there is the income path for those age 50 and over. You might go 40% VOO, 10% QQQ, and 50% SCHD. You're protecting your pile and letting those dividends pay for your lifestyle. You don't have to find new funds. You don't have to learn a new system. You just move the sliders as your life changes. It's the ultimate lazy millionaire setup. At the end of the day, the investing isn't about having the highest IQ or the most complex strategy. It's about consistency. The reason people fail at investing isn't because they picked the wrong ETF. It's because they got bored, or they got scared, or they overcomplicated things until they just stopped. VOO, QQQ, and SCHD. It's clean. It's easy to track. And it has a history of beating the pros. Here is your 3-step action plan. First, audit. Look at your current holdings. Are they serving you, or are they just clutter? Second, commit. Choose your ratio. Are you a 50/25/25 person? Or are you tilting one way? Third, automate. Set up a recurring buy. Whether it's $10 or $10,000, the magic happens when you stop thinking and start doing. Thanks for watching. If you found this video helpful, please hit that subscribe button to help the channel grow.